Well, welcome back, ladies and gentlemen, to Lease Financing. As we move forward and kind of consider leases in the same context or in close context to capital budgeting, the first and foremost issue that we need to address is leases provide the capacity for an organization to essentially acquire necessary assets that might be able to foster growth or continued development of the firm over time. And as such, leasing is often considered to be a substitute for debt financing, whereby it obligates the lessee to a fixed series of payments, and the lessors have the rights to similar to lenders. Now, a difference between lessee and lessor, just for the sake of clarity, lessee is the individual that is actually using the piece of equipment, and the lessor is the individual or organization that is actually owns the piece of equipment and is leasing it out for some series of cash flows. So as such, leasing is considered to use up a business's debt capacity because it is a fixed series of payments. Now, as I just said, the lessee-lessor relationship, there are two parties to any lease transaction. So it's very much a financing decision for the lessee or the individual or organization using the asset, and very much an investment decision for the lessor or the individual that actually owns the piece of equipment or whatever is being leased. So some basics with regards to lease contracts that we need to understand before we go much further. Generally, there is some lease period. Like if you consider, if you've rented a car before, that's lease period, can be extended and adjusted and whatnot. But there's going to be some sort of time frame involved, and there's going to be some sort of timing in the amount of payments during the lease period, either up front, as the piece of equipment is leased over a longer period of time, whatever. And then the option to renew the lease or purchase the asset is generally fostered at the end of the original period. And any sort of provision for payments of costs and maintenance, repairs, insurance, and whatnot, depending on the type of lease you're talking about. If it's a net lease, the lessee will pay. If it's full service or a rental, the lessor pays and of course just passes it through to the lessee in terms of their payment structure. Now, also important to understand the difference between a financial and an operating lease. A financial lease is, as it states there at the very top of the screen, non-cancelable contractual commitment on the part of the lessee to make a series of payments. The key is here that the lease transfers title to lessee before the lease expires, or that has the option of purchase at a bargain. The lease period exceeds 75% of the asset life, and the present value of the lease payments exceed 90% of the value. If any of these conditions are substantively met, most of the economic value of the asset is transferred to the lessee, and we determine and carry it different in our financial statements as a result. And this is all coming fairly recently from basically a combination of different entities, not the least of which is the IRS, the SEC, because quite frankly, a lot of our organizations were carrying leases as a footnote item and understating their debt obligations on their financial statements. So basically giving false information or a false viewpoint to potential investors, creditors, and whatnot. Now, an operating lease is cancelable at the option of the lessee. None of the above conditions hold, and most of the economic value is retained by the lessor. And then, of course, that's an operating lease. So because of the difference in basically what qualifies as a financial versus operating lease, if it's a financial or it's considered a capital lease, it's reported as a fixed asset, and the present value of future lease payments reported as a liability under obligations under capital leases. If it's an operating lease and truly an operating lease, then it still remains as a footnote disclosure. So in our lease analysis, again, we can look at it from a couple different perspectives, one being the lessee, one being the lessor. We're going to focus our attention on the lessee because that's typically where most of us will find ourselves and during the course of daily, weekly, monthly, or in our professional life. There is, however, valuation that takes place on the other side of the equation from the lessor. But for our purposes, we're going to look at dollar cost analysis as well as percentage cost analysis to determine how exactly we're going to move forward from an operational standpoint. So to use a quick example, we've got a for-profit clinic planning to acquire a new x-ray machine. So if the equipment is leased, we can do so on a 4-year lease that includes maintenance with a $280,000 beginning of each year rental payment. And if the equipment is purchased, however, the equipment costs $1 million. We have a cost of capital, or a cost of debt capital, because remember, leases are a substitute for debt capital. So we're only going to look at our cost of debt of 10%. And it's a 4-year maintenance contract, $20,000 at the beginning of each year. We have a residual value or a trade-in value of $100,000. Marginal tax rate is 40%, and we have a 3-year maker's life. Okay, so this is going to be our first exposure to, at least in this class, to tax implications, and we'll talk and walk through those as we go. So, dollar cost analysis. This is the after-tax cost of owning. So, again, we set up our timeline. We establish exactly where and when those cash flows are going to occur. We have our price, we have our maintenance agreement, and we have our residual value or our terminal value out here at time period 4, along with the associated tax. Remember, we're a 40% taxable, so 40 grand comes off the top of that residual value. Now, the nuances here is now we also have the concept of the depreciation shield and any tax savings from basically a cost of doing business incorporated into our analysis. So here we have the depreciation shield, and where do these numbers come from? Well, I've added a footnote down here at the bottom talking about how based on a purchase amount of basically $1 million and a tax rate of 40%, the first year tax shield is our $1 million times 33.3%. Okay, yields $333, and that gives us, at our 40% tax rate, a tax shield of $133. Now, where did I get this 33.3%? Well, the makers table, and you can go out there and do this right now if you want, just Google makers IRS table. You actually will come up with 946 table A1, talks about the asset class that this particular piece of equipment would fall into, which is 33.3%. And what makers allows us to do, by virtue of the divine providence of the Internal Revenue Service in all their glory, provides us the opportunity basically to accelerate, and then that's where the term comes from, makers, modified accelerated cost recovery system, allows us to accelerate our depreciation to be able to take more of our, basically our write-off, if you will, earlier in the life of this particular piece of equipment, so that we can then go in and use that saved capital, presumably, to foster further growth. Now, you also notice that there, even though this is a 3-year class, we are actually extend our depreciation out over 4 time periods. And this has to do with the IRS and their mid-year convention with respect to depreciation. They figure that you probably are not going to be buying a piece of equipment exactly on January 1st or the beginning day of your accounting period. There will be some delay, so you should be able to also accrue some credit. And so they throw part of that, because of the mid-year, into a 4th time period. So if you have a 5-year class, there will be a 6th year. If you have a 7-year class, there will be an 8th year. And it is all broken down on this IRS publication, A1, or table 946, table A1. So with this in mind, then, we've got, as we draw down all of these cash flows, and of course this tax savings here, I guess I should state this is 40% of 20, so we get some tax savings because it is an operational expense. So again, leasing is similar to debt financing. Therefore, what we've got to be able to do is do a comparison of our basically our analysis against basically that after-tax cost of debt, which at 40% based on a 10% cost of debt is 6%. So we come up with a negative $639,267 present value at 6%. Okay, and a footnote here about the tax shield that can fill in some blanks there. Now on the leasing side, it's fairly straightforward. Again, leasing is an operational expense, so we get some tax credit. This is 40% of 280, but straight series of cash flows, again at 6%, present value 617,066. So in order to determine which one's better, we come up with this term called the net advantage to leasing, which just means we subtract the present value of leasing minus the present value of owning and get all our signs correct. Negative here, or minus the negative here, end up with a positive $22,201. So what this tells us is there is a net advantage to lease of $22,201. Okay, so of course that's going to give us a dollar advantage, not unlike the net present value essentially, except in a leasing context. But we also want to look at, of course, as we typically do, based on a percentage basis, and for that we'll use our good friend the internal rate of return, and essentially evaluate against our after-tax cost of debt to determine whether we're on a percentage basis coming out on the positive side of things. So in order to do that, we just line up our cash flows. We put our leasing cash flows on top of our owning cash flows, and we end up with a net cash flow from subtracting the two, and run our internal rate of return on this series of cash flows to come up with a internal rate of return of 4.6%. So our decision criteria now, though, is just because it's positive, what we want to be able to do is say, well, we want to compare, of course, net advantage to leasing. If it's positive, then leasing is the right way to go. And this is compared to our after-tax cost of debt. If it's less than the 6%, the internal rate of return is less than 6%, leasing is a better option. If it is over 6%, or our after-tax cost of debt, then buying will be the better option. And if 4.6, the same as with net present value, internal rate of return, they're always going to point in the same direction. If this is over 6%, the net advantage to leasing should be negative. Okay, I'll say that again. If net advantage to leasing is negative, the internal rate of return will be over the after-tax cost of debt. Okay, so this kind of just restates what I just talked about with respect to comparing between the 4.6 and the 6% after-tax cost of debt. Of course, if there are nuances where what effect would increased uncertainty about the residual value do, well, it's possible that all we have to do is go back to our analysis and discount that number differently, and this goes for capital budgeting as well, for that matter. We don't necessarily have to apply a universal and uniform discount rate to everything. If there are riskier elements within that analysis that bear additional scrutiny and individual attention, we can certainly do that. So if we use, for example, instead of the 6% rate across the board, we decided we're going to use a 10% discount rate on the residual flows, then we end up with a net advantage to leasing increasing to $28,751, meaning that if our owning side becomes more risky and we discount those owning cash flows further, then our leasing option is going to be improved in terms of valuation. Okay, again, dollar cost and percentage cost approaches will always lead to the same lease versus buy decision. And if the cost of leasing is less than the cost of debt, it's possible that a lease option may very well make a previously rejected project, capital expenditure, acceptable as long as we understand the risk profiles involved and know exactly that it's, again, basically a debt service payment that we have to bear. So with this in mind, I offer an example problem back here at the back. Gives you lots of detail within each one. Hopefully will help kind of flesh out the idea. Also provides some very good insight with respect to how one of these should be set up in terms of a kind of a capital budgeting type framework, and how we can actually drive down to that net advantage to leasing, as well as the internal rate of return. Now, a typical sticking point is figuring out depreciation tax savings, and you'll notice this within the capital budgeting framework as well that I'm about to discuss. So why don't we go there, and I will talk about that in a little bit greater detail, so we can look at capital budgeting and lease financing kind of within the same context, if I could find it. Okay, you're also, all right, I'm going to look at capital budgeting first. Gives you the opportunity to kind of see the context. Here at the top, we can talk about short projects, long projects, looking at cash flow timing. That's not anything great to get excited about. Payback period calculation there, discounted payback period. Key thing that we want to get down to is cash flow estimation. Okay, so again, key input variables are all in red here. You can change those however you want. The nice part, though, and the thing that I would encourage everybody to do is, if you are looking to be able to do and use these tools further on down the road, is make sure that you always create what I call a dynamic financial model, meaning everything is linked together, and everything, as I make an adjustment, all my values over here end up adjusting accordingly. Okay, so you see how if I change things, everything kind of adjusts with me. Okay, so why that becomes important? Well, one, if you enter in the formulas correctly, and if you notice here, formulas are all linked together. Okay, so they're all cell dependent. What that does for you is it prevents you from, as long as the formulas are input correctly, prevents you from fat fingering an adjustment as it's made during the course of the several iterations of whenever this comes into play. It also provides you the opportunity to, essentially, as you're going through a meeting with an executive, if someone says, you're never going to get, inflation rate that's too high, it should only be 3%, you can make the quick adjustment and then look at it right there in real time, versus having to go back, refigure everything, come back, and essentially waste people's time. So lots going on here, but good model to be able to show you. The other one is lease financing, essentially going through all the calculations we just did with respect to net advantage to leasing and percentage cost analysis. Hopefully will help fill in the blanks with any of that. And here again, on the cost of owning side, cost of leasing side, and then ultimately down to the net advantage to leasing. So all of these are linked, as I said before, in green. So all of your inputs here are in red. So with that, very quick down and dirty discussion on lease financing. If you have any questions, please let me know, and we'll talk to you in the course room. Thanks so much.